All right, I'd like to start by giving you the 30 seconds pitch on Neptune, and then afterwards, I'm just going to get the clicker though. Oh, that's going to go well. Thank you. We are a NASDAQ listed company, also listed on the TSX. What we do is we provide extraction services to cultivators and to health and wellness companies. We've got 2 facilities, one in Canada and one in North Carolina. We have long-term contracts of 3 years with minimum volumes, so we've got really good visibility on our revenues. Our extraction process is highly automated. It's going to generate some very interesting margins for us. We're fully funded. We have $35 million in cash. We're not here to raise money. And our CapEx spending is towards the end of the cycle, so we should be generating cash flows next year. And if we look at a conservative scenario, using our assets at 50% capacity, we think they can support revenues of up to $450 million with EBITDA margins of around 40%. So the potential for us to generate up to $200 million in EBITDA, and at a market cap of $400 million, we think we're a really attractive proposition to investors. So that's the 30 seconds pitch. I'll get into more details about our opportunities and our story. So what do we do? So we don't cultivate. All we do is we offer a service to clients. We take the biomass that we receive from our client, extract the THC and the CBD, and return those bulk extracts to them. Sometimes we purify it into a distillate or an isolate, depending on the request that they want. We've been in operations for 20 years. The first 17 of these years were in the nutraceutical space. So we were extracting omega-3 out of krill. Krill is that little crustacean similar to a shrimp. So we were extracting that, and in 2017, krill prices went down hard, and the previous management team sold our client list to Acre Biomarin for $34 million. So that cash, with that cash, we paid down our debt, and the excess allowed us to carry our transition all the way up to our commercial operations. We received our extraction license in Canada in January, started our commercial operations in March. We've got 3 main clients in Canada, Canopy, Tilray, and TGOD, where we've signed contracts of 3 years with each of them with minimum volumes. So that's why when I was saying we have very good visibility on our revenues, it's because they've committed to minimum volumes. This summer, we entered into the US. We acquired a hemp processor in North Carolina called Sugarleaf Labs. For us, we see the US market, especially in the CBD, because we can't touch the plant, we're NASDAQ listed. We see the CBD market as being 5 times bigger than the Canadian market, so obviously we want to be in there. What we do in the US is we buy biomass from hemp farmers, we extract the CBD, and we sell those bulk extracts to health and wellness companies. We also provide tolling services to farmers when needed. More recently, a couple of weeks ago, we announced a partnership with IFF, International Flavors and Fragrances. It's a massive company, $12 billion in market cap. And IFF, we couldn't be more happy to have them as a partner. We're going to co-develop with them hemp-derived CBD products, which we're going to commercialize in the US. So more details to come. We issued a pretty slim press release, but we're going to give you more details going forward. So this is our 2 markets right now, Canada and US. The Canadian market is very different than the US market. Canada is highly regulated. The barriers to entry are high. If I would want to start an extraction service company in Canada, it'd probably take me 2 years to get all the way to commercial operations. a year to get my equipment and a year to get it approved by Health Canada. So it's a high barrier to entry, and for that reason, we think our extraction margins are going to stay healthy for a little while. In the US, different. It's easier to start an extraction service, an extraction facility in the US, and we think that down the road we'll need to move closer to the customer to offset some extraction pricing pressure. So in Canada, we have 200 tons of capacity right now. We recently announced that expansion. It was a 7-fold expansion, so it was a massive expansion for us. And that extraction capacity is fully committed to our clients right now. So we need to expand further. We're in a process of adding another 7-fold increase to our capacity with our legacy krill equipment, because right now we're not using what we call this Big Daddy extractor yet. And that expansion is going to be completed in December, and we're going to apply for an amendment with Health Canada in the spring. So we should be able to start our commercial operation in the spring, and that's going to give a lot of torque to our revenues and earnings when we commission that equipment. Another thing that's interesting with our Canadian operations is we're fully automated. We need one operator to run the extractor and one operator of the control board. So not a lot of labor, and for that reason we think we're going to be a low-cost operator in Canada that will allow us to generate some healthy margins. Our US capacity expansion is going to be completed in December, and that will give us a total of 3 million kilograms of capacity annually to process of biomass. So we think we're going to be one of the largest extractor in North America with that capacity. So the extraction process we use is cold ethanol. And the reason why we're using this, there's 2 reasons. First, a legacy. This is the process we were using in our previous life and using our krill extraction. But also it's very appealing, and not a lot of Canadian companies have gone that route. Cold ethanol is faster. We skipped the winterization process. So we're able to get to a winterized oil 5 times faster than using a CO2 process. The other appealing thing with cold ethanol is that it's twice as less energy consumption than CO2 according to our analysis. So we have a faster process that consumes less energy, which again is going to position us as a low-cost producer in the space. These are our 3 main clients in Canada. And that's our growth strategy. We want to be a leading supplier of ingredients to CPG and health and wellness companies. And how we're going to get there? There's five things in our view. First, we're going to increase our capacity in Canada and US. We're in the middle of doing that right now. We're going to expand our customer base. We're going to broaden our customer base into CPG companies. And we're also going to create new product forms to make our client relationships more sticky. We're going to acquire unique delivery forms and technologies, and we're going to develop strategic partnerships. And I'm going to go through those. So this is, again, the same picture as we have in terms of our capacity. What's interesting here is you see what we have in terms of finished product forms. We're going to be able to produce 1,200 vape pens an hour with our vaping equipment. It's being commissioned right now and should be approved by Health Canada this spring. We're also going to be able to fill 1,200 bottles per hour, so significant capacity. And then lastly, we're going to have, we already have capacity to manufacture 200 million capsules a year with our Lonza partnership. So this is what we offer through what we call turnkey solutions to our clients. Is we're not only tolling, not only providing extraction services, but we're also able to produce finished forms, which makes the relationship much more sticky. So we want to expand our customer base into CPG and health and wellness. the partnership with IFF is a prime example of that. You see the market sizes here. IFF has got some tremendous IP and tremendous product development capabilities that we're going to leverage. And, we think that we're able to penetrate most of these markets in the next 2 years. We also want to innovate to create new product forms, and this is nothing new. A lot of people want to do that. What we want to do is we want to offer those new technologies to our B2B clients so that we want to be more sticky. We want to have something unique to offer them and other than extraction services to make that relationship more sticky. And lastly, there's a lot of technologies we can license. There's a lot of deals we see coming on our desks that we can do to increase our product portfolio. And the last thing is Neptune Ventures. This is something new. This is something we've created this summer, along with the arrival of our new CEO. And what we want to do here is we want to innovate and invest alongside our partners. We've announced a partnership with American media to create some media and advertising together. So that's something we're going to do this winter. We also want to develop new products, develop new brands, and expand internationally. And that could be a vehicle we're going to use. Just one note on our new CEO. Michael joined us this summer. He comes from Unilever. He's got a really interesting story. Was very successful early on and invested in a small company called Schmidt's Natural, which is a natural deodorant, and really accelerated the growth of Schmidt's Natural and sold it to Unilever a couple of years ago. And when at Unilever, he expanded Schmidt's Natural to over 100 countries around the world. So I think he wanted to get back to more of an entrepreneurial role, and that's why he joined Neptune. He does have a phenomenal Rolodex in terms of mass retailers, in terms of CPG companies, and IFF is an example of that. So he's going to help us out tremendously, accelerate our growth in the US. So that's it for me, unless there's any questions. Yep. So the question is, how does our business look like in terms of tolling, white label, and finished products? Currently, most of our revenues are tolling. We're starting our contract with the Green Organic Dutchman, where we're going to do all the product, all the finished forms for them. So we're going to do vape pens, we're going to do sprays, tinctures, creams, and that's obviously going to be sold after December in Canada because we are not allowed to sell these products, but we're starting to manufacture them shortly for them. In the US, we're not doing any finished forms now, but it's just a matter of time. We've been starting our operations in the US as well. And over time, I would think that tolling is going to be probably less than 50% of our revenues. And finished product forms and white label is going to probably be the majority of our revenues. Yeah?
Thinking about customer concentration, you have 3 partners in Canada right now. What's your sweet spot? Do you think longer term within that?
Yeah, the question is customer concentration. You have 3 customers in Canada. How are you going to deal with that? Good question. We do have a high customer concentration right now. It's a good observation, and I think we were capacity constrained up to now. Our capacity was all sold, so it was tough for us to approach any clients without having any capacity available, in the next 6 to 9 months. Now we're in a different spot. Our big extraction capacity is going to be coming on stream this spring, so we're starting discussions in Canada. In the US, we've announced a couple of contracts. And our customer concentration should decline over time as our sales grow. So, I mean, I think we're probably at the peak of our customer concentration risk.